Hello, and welcome back to the third and final day of our virtual AGM. I'd like to take this opportunity to say a big thank you to all of our sponsors. We really appreciate your support. We'd also like to thank our speakers and of course all of you for tuning in over the past couple of days. Now, I talked on Monday about one important lesson of the coronavirus crisis. It's a digital future for derivatives is absolutely necessary and possible, and of course within reach. But we can't forget another important lesson: the resilience of financial markets during the pandemic. This, to me, is one of the biggest success stories of the past year. Let's recall what happened during the early part of the pandemic. Markets tumbled and liquidity became scarce amid a scramble for cash, prompting central banks to inject trillions of dollars into the financial system. Despite the volatility, most markets remained open and infrastructure continued to function, enabling firms to continue to access financing and to manage their exposures. During this period, financial institutions played a vital part in helping the central bank measures flow through to the real economy by extending credit to customers, enabling access to capital, and providing intermediation and risk management services. Like all market participants, this was an incredibly busy time for ISDA. As the virus evolved into a global pandemic in March of 2020, we provided guidance on the small number of market closure events that occurred. We also worked with regulators to secure relief on impending regulation deadlines, vital changes to enable financial institutions to remain focused on business continuity, risk management, and supporting customers. There's absolutely no doubt in my mind that the resilience of the financial system and the ability of banks to support their clients through this period of stress was made possible because of the regulatory reforms over the past decade. Bank capital and liquidity positions have been drastically strengthened because of Basel III, while counterparty credit risk is much lower due to the mandatory clearing and margining of non-cleared derivative exposures. As Randall Quarles, the Federal Reserve's Vice Chair of Supervision, has said, banks entered the crisis in a much stronger position than in 2008, which enabled them to play, quote, a central role in the measures to support the flow of credit to the economy, end quote. But while financial institutions were part of the solution in this crisis, there are lessons that can be learned to ensure that markets remain resilient in the future. At the same time, new risks and opportunities are emerging, such as those relating to climate change, which we need to respond to. In my remarks today, I'll briefly sketch out three important areas for evolution of derivative markets: climate risk and ESG, the capital framework, and the post-Brexit landscape. I'll also outline the initiatives ISDA is taking in these areas to ensure that markets continue to be safe and efficient. First, let's look at ESG. It's clear that climate change poses a very real risk, prompting governments across the globe to set ambitious targets to reduce emissions. The financial sector is exposed in a variety of ways, so it's vital we develop the tools to accurately monitor, price, and manage climate risk, something that will require consistent data standards and the development of climate risk modeling and scenario analysis. One thing is certain: financial markets will play an essential role in the shift to a greener economy by mobilizing the estimated $110 trillion in capital needed by 2050 to fund new sustainability initiatives and infrastructure, as well as enabling companies to manage their risk. As discussed on our ESG panel yesterday, a critical component of the success of this transition is the development of a transparent and resilient carbon market. This was the #1 recommendation in a recent CFTC report on climate risk. The report states that financial markets will only be able to efficiently channel resources to activities that reduce carbon emissions if, quote, an economy-wide price on carbon is in place at levels that reflect the true social cost of these emissions, end quote. Establishing a price on carbon will help provide transparent pricing of climate-related financial risks and encourage further development of ESG-related financial products, vitally important to driving investment towards new, low-carbon technologies. Of course, for this market to grow at scale, we need standardization of data, terms, and documentation to create efficiencies and minimize costs. This is very much in ISDA's DNA and will be a focus of our work in this space. ISDA has already published a variety of templates to support trading of emissions and certain types of environmental derivatives, including the US and EU emissions annexes. We're currently exploring how we can extend this to other areas. For example, last month we published the US ISDA Renewable Energy Certificate Annex. As carbon and other ESG derivatives continue to gain traction, and as market participants seek greater levels of contractual standardization in these specific areas, we will work with our members to identify and address emerging needs to support the development of this market. Now let me turn to the capital rules. This year, we will see several jurisdictions develop rules to implement the final Basel measures, which include the fundamental review of the trading book and a revised CVA capital framework. As national regulators transpose the global Basel standards into local rules, there is an opportunity to review what happened during the pandemic and consider the impact the changes will have. As I mentioned, changes to the capital and liquidity rules over the past decade have undoubtedly increased the resilience of the banking sector and made it more able to withstand stress. Since 2011, for example, internationally active banks have added about €2 trillion in common Tier 1 capital to their balance sheets. However, the current rules were shown to be pro-cyclical during the extreme market volatility of last year. According to the analysis of 20 banks compiled by ISDA, GFMA, and IIF, there was a sharp increase in trading book RWAs during the first quarter of 2020, at the height of the coronavirus crisis. Ballooning RWAs could have severely curtailed the ability of banks to provide intermediation services and support the economy. Fortunately, regulators took a flexible approach and provided temporary relief to smooth the pro-cyclical impacts, but it's a reminder of the importance of an appropriate, risk-sensitive, and non-pro-cyclical framework. While the new FRTB framework has been designed to reduce pro-cyclicality and market risk capital requirements, our analysis shows that it still remains unnecessarily conservative. National authorities should take the opportunity to ensure that the rules are calibrated appropriately and will not inadvertently choke off the supply of credit to the economy when it's most needed, all the more important as we continue to recover from the economic damage caused by the pandemic. As local regulators develop their rules, ISDA will provide input, data, and analysis where necessary, with the aim of achieving a coherent and risk-appropriate capital framework that takes the lessons learned from the pandemic into account. We're also helping banks with their implementation through our standardized approach benchmarking initiative. This has been a terrific success to date, enabling 58 banks to compare their approach with an industry standard. So far, the focus has been mainly on benchmarking the FRTB standardized approach, but we're extending it to other areas of the framework, helping more and more banks achieve a consistent interpretation and implementation of the rules. Finally, I'd like to touch on the post-Brexit landscape. One of the lessons from the COVID crisis was that stresses emerge when liquidity dries up. It is therefore important we don't create avoidable barriers that limit the ability of firms to tap into the widest pool of counterparties. Unfortunately, the lack of equivalence between the EU and UK trading venues has made it much more difficult for entities in those jurisdictions to trade with one another. As it stands, EU entities trading derivatives subject to the EU derivative trading obligation are required to execute those transactions on an EU trading venue. Meanwhile, UK firms must trade derivatives subject to the UK DTO on a UK venue. Without equivalence, in-scope trades between EU and UK counterparties can only take place on US CEFs, which are recognized by both jurisdictions. In fact, analysis shows US CEFs have already captured a large slice of euro and sterling denominated interest rate derivatives business, as you can see on this chart. Those firms that are not willing or able to use CEFs have no choice but to only trade with the counterparties on local venues, resulting in split liquidity, less choice, and potential pricing impacts. We continue to believe that trading venue equivalence is the only way to comprehensively solve this issue. Given EU and UK trading venues rules are virtually identical, we can't see any technical or legal reason why equivalence isn't possible, so we continue to urge regulators to take appropriate action. Equivalence for clearinghouses is even more important, as a mass shifting of exposures from one CCP to another would cause severe market disruption and fragmentation that would disadvantage European banks. While a temporary equivalence determination is in place until mid-2022, we believe EU clients should be able to clear where they choose based on risk, liquidity, and pricing. Equivalence is the best approach to maintain financial stability and is justified given the similarity of the rules. I'd like to close my remarks by reiterating the point I made at the start. Derivative markets continue to function throughout the period of extreme stress last year and played a vital role in the transmission of central bank support to the real economy. As our markets continue to evolve, ISDA's priority will be the same as it has always been, to ensure that the foundations are in place for safe, efficient derivative markets. Thank you again for attending this year's virtual AGM, and I'm looking forward to seeing all of you in person next year in Madrid.